January jobs data coming in hotter than expected today. 353,000 jobs added in the month, nearly double what the street had estimated. And of course, wages jumping, giving the Fed even more breathing room to hold rates steady. Let's dig into how investors can use labor dynamics to inform their portfolio. Jose Rasco, HSBC Global Private Banking and Wealth Chief Investment Officer, is here to break this down. Thank you so much for joining us this morning. So as we can see here, you have this hot jobs number here, gives the Fed some breathing room when it comes to rate cuts. But what are some of the other pressures then as you look within the labor dynamics that investors should be aware of?
Well, I mean, you want to keep an eye on wages. And the bad news is wages did tick up in this monthly report. But the really good news is that if you look, they have been decelerating for quite a few months now. Remember, this is a January report heavily affected by seasonal factors, not just in terms of employment, but in terms of wages. We saw the average hourly earnings tick up a little bit. And minimum wage was raised in 22 states yet again this year, third year in a row that more than 20 states raised their minimum wage. I would expect that to even out as we go through the balance of the spring. But for now, we saw a bit of a jump in wages as well.
So what does that mean, Jose, when you're looking at your portfolio? Obviously, the question is going to be, what does this mean for the Fed? The answer would be it's not just one data point. And yet we're coming off of a meeting and press conference from the Fed chair where he really tempered expectations for anything come March.
Well, if you look at the consumer sentiment data, the consumers are feeling much more comfortable, much happier, and their expectations for inflation are lower, right? Which these are all very positive signs. But in terms of figuring out where the Fed is going to go, how they're going to pivot, and when they're going to begin to cut rates, we still think they're going to move in the second quarter and cut rates 3 times this year, and then do the same thing next year, cut rates another 75 basis points next year. So we're thinking the Fed's going to move, but not quite as aggressively as the market.
So Jose, as we look at the consumer, we think about things like inflation pressure that comes from that. If wages are creeping up and people are feeling better about the economy, want to spend, not seeing that employment number ticking down though, what does that mean for that distance between where we are now and the 2% inflation target for the Fed?
Well, if you look at the core PCE deflator, which is what the Fed looks at, for the last 3 months, 1.5%. If you look at the last 6 months, it's rising at 1.9%. So the core PCE deflator, which they've said is one of their measures, right? The PCE deflator and the core, we're already below their 2% target. And remember, the 2% target historically has been a symmetric target. It doesn't mean they want to go to that data point and stay there. They want to, vary around that data point, some sort of average as they go forward. And we think we're very much on our way there. So that's the good news. And it's important to remember, when people talk about the markets and what does this mean for our asset allocation, we think we're going to see volatility here in the short term, political reasons, geopolitical. It's an election year, presidential election year, and a whole host of other factors like earnings that have to be recalibrated given fourth quarter numbers. But the bottom line is think back to 94, 95, right? In 94, 95, the Fed took Fed funds from 3 to 6 very quickly, and then they began to cut very quickly as well. And we went through the rest of that business cycle with Fed funds at about 5 to 5.5. And the economy zoomed and the markets did very well. And technology in particular, which is one of the sectors we happen to like, did very well also.
So is that where you're increasing your exposure right now?
Well, what we did was we're looking at high quality companies. We want to be careful with small cap and mid cap at this point in the cycle because we do see some risks in terms of some areas of the financial sector, right? But bottom line is we think that tech should do well, comm services should do well. The consumer will probably trade down a little bit this year in terms of quality. But remember, real disposable incomes are strong and employment gains, obviously, as we saw this morning, look pretty good. Unemployment rate is barely budging. So we think the consumer looks relatively healthy and inflation is down from 9% to 3.4, right? So I think we've got some good indicators for the consumer. And those are some of the sectors we're focused on, in addition to industrials. Now, remember, this renaissance in manufacturing here in the U.S., manufacturing employment boomed in January, right? And we continue to see major inflow of capital and technology. And we're going to continue to see, remember, construction of manufacturing facilities in this country is rising at more than 70% year over year, 70. That's monstrous.
So then, Jose, for people who had done a little bit of profit taking with the tech rally, then where should they be positioning themselves? You mentioned some of the sectors, some of them a little bit more beaten up as well. Is now the time to get in, or should people wait given the volatility ahead?
Well, look, there's definitely going to be volatility, but I think if you look from the broader asset allocation perspective, we like alternatives. We like things that are uncorrelated to the equity markets directly. We also like fixed income. We saw the peak in policy rates in July. We believe our economists nailed that call. And we think market rates will go down with inflation and with somewhat slower economic growth. We think the peak in growth was the third quarter of last year, but we'll still see good growth this year. And therefore, if we avoid recession, inflation stays low and stable, and the Fed begins to cut rates, which we think they will. Remember, about a third of the federal deficit has to be reissued this year, repapered this year. And we have commercial real estate, where about $1.5 trillion dollars of debt in the next 2 years is going to have to be tackled. So all those issues together suggest the Fed should ease, which makes fixed income very attractive from our perspective, extend duration, capture those longer rates, and in terms of the equity markets, broaden your diversification into other sectors like industrials, like the consumer, and even comm services we think is going to do well. And look at financials. Financials from when the Fed pauses over the next 12 months and when they begin to lower rates, financials historically have been a good performing sector, one of the top three sectors going back to 1982 in the S&P 500, right? So those are the top quality banks.